India stocks cooling off in the past few months with the iShares India ETF down around 14% from its 52-week highs. That would qualify as a correction, I guess. Seeing pressure as the dollar index strengthens. But our next guest says the outlook for India remains strong. Joining us now is Dhawan. He is PIMCO's head of emerging markets portfolio management team. Pramal, good to see you. So you say buy the dips. This is already quite a dip. Are you implying that we should expect more?
No, I think it's moved quite a lot, and I think the buy the dip is because the fundamentals still remain very strong in India. We're looking at growth, real growth in India at 6.5% this year into next year. Inflation's coming down quite nicely, around 4.5%. So we think that's going to allow the central bank to be able to cut nominal interest rates by at least 50 basis points. More if the Federal Reserve cuts rates again this year. And that's going to really help to stimulate the economy. And on top of that, we're expecting more liquidity injections in India, helping to support home buyers and the consumer. So really, it's the fundamental backdrop that we see is going to be able to drive multiples in India. So that's why we like the story there.
How should we expect to see India affected versus some other international markets, depending on how the Trump administration's tariff policy plays out?
Yeah, so the tariff policy is really front and center of everybody's minds, and it's strengthening the dollar, weakening emerging market currencies accordingly. I think the tariff policy is only one side of the ledger. On the other side is the ability to be able to de-escalate some of these geopolitical risks that are going on in the Middle East and with Russia and Ukraine. And I think that's really, really important to be able to release capital into emerging markets and reduce the overall levels of risk premium. So it's really a double-edged sword. On the one hand, the tariffs are a net negative, but on the other hand, the reduction of geopolitical risk premium should allow capital to flow and find those good opportunities in emerging markets, which we think that there are quite a number of them that are out there at the moment.
Okay. Now, I believe you like Turkey, Nigerian currency, and Ecuador in 2025. Given the kinds of shocks and instability that's possible, why those?
Yeah, I think they're all idiosyncratic stories. So Nigeria, I think, has done a wonderful job in terms of stabilizing its currency. They've hiked nominal interest rates to north of 30%. Right now, they've stemmed the backlog of dollars leaving the country. In fact, net dollars are now coming into the country, again, being able to capitalize on that very high level of nominal interest rates. And the external balances have really corrected. They're sitting on a record, 10-year record surplus in terms of their external balances. So they have a lot of ammunition to be able to support the currency. And those are really the ingredients that you want to see from an international investor's perspective to be able to capitalize on the carry trade. That same sort of playbook played out really well last year in Turkey, yielding around 35% returns for currencies. A little bit less for equities, but we still think it is a currency trade this year. We're expecting less or lower returns in Turkey, but still the same playbook persists. And in Ecuador's really an extension of just liking the Americas. We think under this new administration, we like the Americas a lot. At the behest of Asia, we think Asia is quite tight and overvalued, and we think some of that capital flow is going to come into the Americas. Ecuador and Mexico stand to be net beneficiaries of that. Ecuador has a forthcoming election in February, and assuming that goes to market expectations, we think that the market will validate the prudent policy mix there and push bond yields much higher.